Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 3. This is Section E2. This is a remembering and understanding topic. Identify the considerations relating to the measurement and disclosure of the fair value of investments in securities in an audit. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So make sure you check that out. And after you watch that, you're going to want to learn more. So make sure you also check out becoming a SuperfastCPA Pro member. In today's video, we're only going to be going over 5 questions, but SuperfastCPA Pro members get access to the full 10-question version of the video when we post it in the member forum, so that members can get a little bit more practice and a little bit more understanding. So if you like this and you like our other videos and our other products, make sure you check out becoming a SuperfastCPA Pro member. Now with all that, let's dive straight into the questions. All right, here we are at question 1, and something I always like to point out when it is an option is a good strategy for test day is to read the last sentence of the question first. Read the last part first, because that will very frequently give you context for what the rest of the question is about, so that as you're reading through it, you already have an idea of what you're looking for instead of starting at the top and then kind of getting to the bottom and realizing, oh, that was what I was supposed to be doing that whole time. Now, this strategy won't help with every single question, but it is a very good habit to be in for test day because it will help with a lot of questions. So be in this habit. We're going to do it here. Which of the following is the auditor's most appropriate responsibility in this situation? Let's go up to the top. Falcon Manufacturing holds several complex investment securities, including structured debt instruments. Management uses a valuation model based on projected cash flows and internal assumptions about interest rates. The auditor notes that the model and assumptions have not changed from the prior year. Management states they intend to hold the investments to maturity. So again, which of the following is the auditor's most appropriate responsibility in this situation? Let's go through the options. Option A, accept management's intent to hold the investments as sufficient support for their valuation. Option B, recalculate all fair values using an independent pricing model. Option C, evaluate whether management's valuation model and assumptions are reasonable and properly supported. Or option D, confirm that the internal audit team approved the valuation approach. Okay, so which one of these things is going to be something the auditor is most likely to be responsible for in this situation? If you don't really know, what auditors are supposed to do when it comes to evaluation of complex securities or fair value or things like that, that's okay. We're going to use this question and the questions in this video to learn about that. But if you want, give it a try, pause the video, and when you're ready, come back, we'll look at the answer together. Okay, here we are. The answer is C, evaluate whether management's valuation model and assumptions are reasonable and properly supported. Okay, let's go through the explanation. The auditor is responsible for evaluating whether fair value measurements are reasonable and supported by sufficient appropriate evidence. In this case, the use of internal assumptions means the valuation is based on level 3 inputs, and we have talked about that in a previous video, the different kinds of inputs. Level 3 is basically the worst kind. You don't want to use it if you can help it because it doesn't really have anything that's observable or that's in the market. So it's kind of just the management doing their own thing. So again, level 3 inputs which carry greater subjectivity and audit risk. The auditor doesn't have to recalculate values independently, which was option B, but must assess the reasonableness of the model and assumptions. Management's intent to hold the investment, that was option A, affects classification, not whether the fair value is fairly stated. So that doesn't really have anything to do with the fair value being stated fairly. And then approval by internal audit, and that was option D, doesn't relieve the external auditor of their responsibility. Auditors must also assess the risk of material misstatement, determine whether management has the intent and ability to act on key assumptions, and ensure disclosures comply with GAAP. So these are all factors, these are all things that auditors are going to need to consider when they are looking at these fair value estimates and these fair value assumptions and things like that. So again, the auditor is responsible for evaluating whether the fair value measurements are reasonable and supported by sufficient appropriate evidence. They're also responsible for assessing the risk of material misstatement, determining whether management has the intent and ability to act on key assumptions, and to ensure that the disclosures comply with GAAP. So those are some of the auditor's responsibilities. Now let's go to the next question. All right, here we are at question 2. Why is segregation of duties an important internal control in the fair value measurement of investment securities? Let's go through the options. Option A, it ensures that investment income is recorded before year end. Option B, it prevents reliance on observable market data when pricing securities. Option C, it eliminates the need for fair value disclosures under GAAP. Or option D, it reduces the risk of bias or manipulation in the valuation process. So again, why is segregation of duties important as an internal control for the fair value measurement of investment securities? Now, if you have any idea, that's great. Pause the video and think about this. But if you have no idea, that's okay. We are using these questions to learn what we're supposed to know. So let's go ahead and take a look at the explanation together. All right, here we are. The answer is D. It reduces the risk of bias or manipulation in the valuation process. So that's why segregation of duties is important in this process. Let's go through the explanation. When auditing fair value measurements, auditors must understand relevant internal controls over the process, including whether there is appropriate segregation of duties. If the same person both initiates transactions and performs valuations, there's a higher risk that the valuation could be biased or manipulated to influence financial results. So that's something that the auditor is going to need to consider, going to need to pay attention to. Now let's go through the other options really quick. A is unrelated. Timing of income recognition is a different issue. It's not the same thing as this. Option B is incorrect because segregation of duties has nothing to do with market data availability. And then option C is wrong because GAAP still requires fair value disclosures regardless of internal control structure. So again, that was why segregation of duties is important as an internal control for the fair value measurement of investment securities. Let's go to the next question. All right, here we are at question 3. Which of the following provides the most reliable audit evidence when measuring the fair value of an investment security? So let's go through the options. Option A, a quoted market price in an active market for an identical security. Option B, a price quote from the broker who originally sold the security to the entity. Option C, management's internally developed cash flow projections using level 3 inputs. Or option D, a valuation estimate provided by the entity's internal audit department. Okay, so again, what is the most reliable audit evidence for measuring the fair value of an investment security? Now, if I'm being honest, just by reading through these options, you can probably have an idea of one or two of them that are more obviously correct than the other ones, or you might already know this. So go ahead and pause the video, think through this, and come back when you're ready so that we can look at the explanation together. All right, here we are at the answer. A quoted market price in an active market for an identical security. You could probably have kind of reasoned your way through that one, so let's go over this to make sure that it makes sense. Under the fair value hierarchy, level 1 inputs, and that's quoted market prices in active markets for identical assets, are the most objective and reliable source of fair value evidence. So that's something that the auditor needs to keep in mind, needs to consider very frequently because they need to make sure that they know, is this a level 1 input? Okay, so it's probably more reliable. Is this level 2? Okay, maybe not as reliable. Level 3, not very reliable at all. And again, we talked about that in a previous video. Level 1, like it says here, quoted market prices in active markets for identical assets. Level 2 might be for similar assets or things like that. Kind of, that's the general idea. And then level 3, unobservable, doesn't really have anything else in the market that's like it. Let's go through the other options and why they're not quite right. Option B, broker quote from the selling broker. That actually would not work because it may be biased and lacks objectivity because it's from the same broker who sold the security to the entity. So, that would introduce a lot of bias. Option C, about level 3 inputs. This involves unobservable data like I was mentioning and carries a higher risk of material misstatement. And then option D, internal audit valuation. This is not a sufficient substitute for independent audit evidence. And we've kind of talked about that in a previous video about the internal audit function and how it relates to the external auditor. And pretty much always, whatever the internal audit function does, it has to be under the control, under the supervision of the external audit. It's not going to be a substitute for the external auditor doing their own thing. Auditors should prioritize observable, market-based evidence over internally generated or potentially biased sources when evaluating fair value measurements. All right, again, that's something that the auditor needs to keep in mind when they're considering this. Let's go to the next question. All right, here we are at question 4. Again, we're going to read the last sentence first. What should the auditor focus on when evaluating this situation? Let's go up to the top. During an audit, the auditor reviews a client's year-end investment records and notes that several debt securities purchased earlier in the year were classified as trading securities. However, management later states that they now intend to hold these securities until maturity and have updated internal documentation to reflect this intent. The securities are still being reported at fair value on the balance sheet. So again, what is the auditor going to focus on when evaluating this? Let's go through the options. Option A, whether the securities' fair value changed significantly since purchase. Option B, whether the classification aligns with management's intent and affects valuation and presentation. Option C, whether the debt securities are from a related party. Or option D, whether management approved the change in classification before the year-end audit began. So what is going to be something that the auditor needs to be looking for, that they need to consider in this situation? Based on what we've learned so far, you might have an idea, but if not, that's okay. We're going to look at the answer together, but if you want, go ahead and pause the video and come back when you're ready. All right, here we are. The answer is B, whether the classification aligns with management's intent and affects valuation and presentation. So that's what the auditor is probably going to focus on when they're evaluating this. Let's go through the explanation. Investment classification, such as trading, available for sale, or held to maturity, determines both how the investment is valued, whether it's valued at fair value or amortized cost, and how changes are reported. So that affects all of that. Classification must reflect the management's intent and be applied consistently. Misclassification can lead to incorrect valuation, misstatement of income or OCI, and misleading presentation. The auditor's role is to evaluate whether the classification is appropriate and supported, especially when it directly impacts fair value measurement and disclosures. So the auditor is going to need to pay attention to the classification of the said investment because that's going to affect how it's going to be measured and how it's going to be disclosed, and the auditor needs to be looking at that. All right, now let's go to the next question. All right, here we are at question 5. Which financial statement assertions does this confirmation most directly support? Let's go up to the top. An auditor obtains a confirmation from a third-party custodian stating that several investment securities are held in the client's name as of year end. the fair value of these securities is material to the financial statements. So again, what financial statement assertions does this confirmation most directly support? And we've been kind of mentioning assertions throughout multiple videos, throughout a lot of videos. Let's go through the options. Option A, completeness and valuation. Option B, rights and obligations and existence. Option C, classification and accuracy. Or option D, presentation and disclosure. So again, based on them receiving this confirmation from this third-party custodian, what is this going to most directly support when it comes to financial statement assertions? If you kind of understand the assertions and know what they mean, then you probably already know the answer or you have a general idea. If not, that's okay. We're going to look at the answer together right now. All right, here we are at the answer, B, rights and obligations and existence. So let's go through this. Confirmations from independent custodians provide strong evidence that the investment exists as of the balance sheet date and the client has legal ownership, so that would have to do with rights and obligations over them. So confirmations basically are evidence typically of existence, rights, and obligations. These are two key assertions when auditing investments measured at fair value. Valuation, classification, and completeness may require additional procedures, but existence and ownership are best supported through direct confirmation from a third party. And existence can also be done by observation, but again, the rights and obligations is something that is also going to be helped by the third party because they can kind of make sure that it's known, yes, this is correct, yes, this is owned by them, or whatever the case is. So we learned a lot in just 5 questions. Before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about the assertions that an auditor needs to consider in these situations where the auditor is trying to make sure that the assertions fit the fair value measurement and things like that, or whatever the case is. Again, you see these things popping up throughout the questions. And as you're doing this each day, you're building your own personal repository of the most important things you learned from the questions in your own words so that you are prepared for test day, again, based on the questions that you did in your review course. So with that, let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, the auditor must evaluate fair value assumptions. So this is something they need to do. Auditors must assess whether management's fair value models and inputs are reasonable, supportable, and in line with GAAP. This includes understanding the valuation method, checking assumptions, and evaluating the sufficiency of audit evidence. Now let's go to the next one. Internal controls impact valuation reliability. Weak controls, especially lack of segregation of duties, can increase the risk of biased or inaccurate fair value estimates. Auditors must understand these controls to assess reliability and determine the necessary audit response. And then let's talk about the sources. They do matter for fair value evidence. The reliability of fair value evidence depends on the source. Observable market data, that was level 1, is most reliable, while internal models and broker quotes require greater scrutiny and possibly corroboration. So, level 2 or level 3 would require greater scrutiny or corroboration. Now let's talk about the next one. Classification affects valuation and disclosure. Investment classification determines whether fair value or amortized cost is used and how changes in value are reported, and that would be things for like net income versus OCI. Auditors must evaluate whether classification is appropriate based on management's intent and ability. So again, this is another thing that auditors need to be aware of. They need to be understanding how the classification is going to affect and determine the fair value. Now let's talk about the last one. Existence and ownership must be proven first. Before assessing fair value, the auditor must confirm that the investment exists and that the entity has legal rights to it. Independent confirmations are the strongest evidence for these assertions. So again, these are all things that the auditor needs to consider when they are trying to consider the management assertions over fair value measurement and things like that. Now that is the end of the YouTube version of the video. Remember, we only went over 5 questions today, but SuperfastCPA Pro members are going to get access to the full 10 question versions of the video when we post it in the member forum. So if you like this and you like our other products, make sure you check out becoming a SuperfastCPA Pro member because again, they get access to a lot of great stuff, including the full 10 multiple choice question walkthrough videos of these videos so that they can get a little bit more help and understanding. And the easiest way to become a SuperfastCPA Pro member is actually by first going to superfastcpa.com and signing up for our free 1-hour webinar training. Again, it's free, it's 1 hour, and we will teach you the key ingredients to passing the CPA exam. And after you watch it, you're going to have a much better path to becoming a SuperfastCPA Pro member. So make sure you check out the webinar, then check out becoming a Pro member. If you like this video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.